Welcome to another episode of Business Monday, where we're here to support you in business and to support your life. Today, we're going to talk about a topic that concerns a lot of Australians, mortgage. A lot of us in our age are start thinking if we haven't got a mortgage before, this is the time that we should really start looking. Today, I have Mandy here. She is our group expert in as a mortgage broker. So thank you, Mandy, for joining us today. Please tell us a little bit more about you.
Thank you, Martha. Happy Monday, everybody. I apologize if my voice is a little croaky. Hay fever is absolutely kicking me at the moment. Okie dokie. So I'm Mandi-Lee Krpez. I own KPZ Finance. I am a mortgage and personal finance broker located in Western Australia, but I do service all over the country. I'm here today just to answer a few questions in regards to some or what people have actually asked me or what I have seen come up when I've been helping people purchase their homes. So it's not necessarily their first home, it can be an investment property, and these kind of go across all three of those purposes. So
That is great because we do have a lot of like mums here as well in our group. So does the age of our children matter when applying a home loan?
Absolutely, it does. Particularly if you are receiving Centrelink benefits and if you are receiving child support payments. So the Centrelink payments, which I get asked for specifically from lenders, are parenting payment and the family tax benefit A and B. So whether or not you're receiving a combination of all of those, I need to know which ones they are, and then the amounts that you receive are actually also really important, because I know there are maximum limits that you can receive, but you might not reach or you might not actually receive those limits. So I need to know how much that is. Now, why we need to know the age of the children is a lot of lenders really like you to be receiving those benefits for about 8 years. Well, actually about 5 years, sorry. So from 13 to 18. So the cutoff for a lot of lenders is if your children are over the age of 13, we can't actually take that income into consideration. So that's one of the things that we really need to be aware of. Some of the other policies relating to child support is, are you registered through child support? Are they the ones that are actually looking after the agreement and the payments? Or do you have a private agreement that is registered with child support? Or do you have just a verbal agreement between, you're still amicable and you've got that arranged between yourselves? So some lenders will accept private arrangements that are registered with child support. Some lenders will only take child support agreements, which are controlled, I guess, by child support. So they actually monitor it. And then if you don't actually have an agreement in place, there are some lenders that will take it's like a stat dec, so a statutory declaration. So it's just showing that you guys are both in agreement with what is being paid. Again, child support is looked at with age restrictions as well. So lenders are starting to become a little more flexible, especially considering that some Centrelink payments and child support is going up until the age of 21. So depending on if that child is still considered a dependent at 21, I know when you think children and child support, you think little ones, but when you've got a child that's going into university and they're not really supporting themselves, they're still eligible for those payments. But when it comes to the lenders, the cutoff is 18. So that's one of the reasons why I really, really need to be aware of how old your children are. And yes, it does matter when it comes to applying for your home loan.
Yeah, it is interesting, about like how our kids actually affect our borrowing cap, like the cap that we can actually apply.
Absolutely. So One of the other aspects when it comes to doing the serviceability calculator is there is a standardized, I guess, expenditure measure that we actually adhere to. So it's built into the lender's calculators. I don't have the capacity to be able to change it. So it's called the household expenditure measure. And it is pre-programmed in by an organization in Melbourne, and it's determined on a range of factors. So your income level combined with your postcode, combined with the number of dependents you have, the average amount that you would spend every month is actually calculated. And so that is now affecting as well your servicing calculator, so how much you can actually borrow. So if you've got one dependent compared to having three dependents, that can actually fluctuate anywhere up to like $250 to $500 a month.
I see, I see. I have a question from the audience here. She said that, can you combine equity from two different houses, one our home and the other is an investment, to get another mortgage so we can move house?
Can you just say that question again?
Yeah,
Can you
it's
combine the two?
the two different houses, one our home, the
Yep.
other an investment, to get another mortgage so we can move houses.
Sure. It really depends on the individual circumstance. So everything I'm saying at the moment is just general in nature. So it's not reliant on your specific, or it doesn't take into account your specific situation. So yeah, if you've got your owner occupied home and you've got an investment property and you wanted to look at, do you want to purchase another house to move into? The questions that I need to ask are, what are you going to do with your owner occupied house? Are you going to sell it, or are you going to turn that into an investment property? Again, it comes down to the serviceability if you wanted to turn it into another investment property. So we do take into account the rental income that you would receive, but at the same time, if you can't actually service that loan in the instance that there weren't any occupants in there, if you didn't have any body renting it, the bank has to look at protecting their asset, because while you still have a mortgage, it's actually their asset. So they will want to know, can you service that loan if you don't happen to have anybody renting it? So it
I
is
see.
definitely workable. I'm more than happy to look at anybody's situation. In fact,
Yeah.
Martha, for all the people watching this today, if you were to contact me and use the code word, yeah, the girls, you get an additional extra 30 minutes free of just a discovery call. So it's literally just having a look at your circumstances. So instead of a 30-minute call, you get a 1 hour call with me.
Great. Okay, I'll put down the note there to actually book in a call with you. So the next questions that I have, I notice that a lot of us are struggling a little bit, and a lot of the work condition has been changed. Like, can people have a loan when they're only working casual?
Yes, they can. Again, it depends on the lender. So every lender has a different policy towards casual working. Majority of lenders would like to see you in your role for 12 months. Now, I know that in a lot of aspects, so if you've got a casual job which is seasonal, you can change employers providing you're still in the same industry. So again, lender specific, this is where our job as brokers come into it, where we have to know which lenders will accept what form of employment. But primarily minimum of 12 months casual. Now, one of the key things that we really need to take, I need to let you guys know, are there 3 cardinal sins in mortgage broking or any sort of like loan applications? Is getting a new job, specifically if it's in a new industry, you're going to actually delay any sort of application process. If you're moving into a full-time position, lenders primarily want to see a contract or a letter of offer, and they would really like to see you see out your first pay cycle. So having that first pay slip come through, just so that they can confirm that what is on your contract is actually what you are getting paid. What are some of the other things? The second cardinal sin that we have is going on an overseas holiday. I understand that sometimes people want to book holidays. Yes, if you've got the holiday, if you've got the leave there to take it, absolutely. But just know that sometimes we need to get in contact with you. Sometimes there might be documents that need to be signed. And if you're overseas and you don't have access to a printer, that can delay the application process as well. And if you go out and you take some of the savings that you have for your deposit and you buy a new car, obviously, I know things happen. Sometimes you can't avoid buying a new car, but if you come out with a new boat or a caravan or a jet ski, or you've taken out a loan, we have to go back and reprocess your lending capacity again, because you've just taken on some more debt. So I know I did go on a tangent from being casually employed to now suddenly having this conversation about avoiding certain things. But if you're jumping around and you're not really sure where you want to go, and you've come to a mortgage broker and gone, I want to buy a house, and then you go and buy a car, and then you book an overseas holiday, and then you change jobs, your mortgage broker is going to be just stressing a little bit, because you've just made our job that little bit harder. And it also doesn't look good on the application if you have got multiple loan inquiries and applications and multiple jumping around with jobs. Again, seasonal jobs, we can understand that we can create a narrative around that. It's a story. So fruit picking is probably the one that comes into my head at the moment. So it's seasonal. You go from one employer to another employer to another employer.
Mm-hmm.
We can create the story to show the lender that you're actually gainfully employed over multiple employers. But the thing is that you actually have got that consistency. So yes, you can get a job while you are casually employed. It's just really important to keep a consistency there.
I see, I see. That's a very good thing to look at, because I think even for Malcolm, we are looking at buying a car, using like some sort of like rental loan service. We don't actually own the car, but it's actually from a finance company that we can have the car. And he was thinking about that, but one of his deciding factor was that, is that going to affect my chances of buying another property? I think that was where he stopped to reconsider.
It can, because if you're doing it, is it going to be like through work, or is
Yeah.
it okay? So is it a novated lease? Is that
no idea?
okay? So there are some businesses out there that do offer leasing, so novated leases and other leasing opportunities to do vehicles. It really depends on whether or not that matches with your situation. So it can affect your borrowing capacity, because it depends on whether or not those payments come out pre-tax or post-tax.
Yeah.
And then how long is that lease going to be? Is there going to be a balloon payment at the end of it, or will you continue to take out another lease at the expiry of that particular car lease period? So there's a lot of factors to talk about. And again, there are quite a number of organizations that do the salary sacrificing to do that, but that's generally what it comes down to, is you're looking at taking out a lease for a vehicle using your pre-tax income. One of the situations that can come up, one of the questions is, is it something that can be voluntarily stopped, those payments? And the short answer is no, because you're actually in a contract. So if it came to the point where that was a singular issue that was potentially,
Mm.
restricting you and limiting your capacity, I can't really assist you there because you're in a contract. So those payments have to continue coming out.
I see, I see. And I think that a lot of us that this was something that I'm not aware of. I thought that at our age, like at 40, we should be clear of our hack stack. But unfortunately, I realized that a lot of people are actually still have it. So how does my hack stack affect how much I can borrow?
Oh, yep. I have a HECS step. I'm still plugging away at it. And when it got indexed at what it did last year, I'm going to be honest with you, Martha, I think I vomited in my mouth a little bit. It was just like,
Hmm.
oh my God. I got more put onto it than what I paid off the previous year. Like, oh, that hurts. It hurts my heart and it hurts my soul to know how much I got indexed myself. So yes. All right, so HECS debt can affect how much you borrow, and how it affects it is by how much you're actually getting paid. So what is your income? So we all know that the repayment threshold was actually increased to $54,435 gross. So that's your taxable income. So once you start earning above that per year, you're now required to make compulsory repayments. So I am going to put into the comment section a link where you can actually calculate how much you will need to pay. So it is just a guide, this calculator. So you can put in, well, actually the first one, because I've got two links that I can put in. One is to the ATO website, which shows you the income threshold limits compared, and then shows you the percentage of your income that you actually have to pay annually onto your, well, you have to pay to the tax man to pay back your tax. So an example is if there was somebody earning $84,108 per year, you would actually, well, between 84,108 and 89,154, you need to pay 4.5% or $3,870 of your gross income back in repayments. So if you were on a weekly pay cycle, so if you got paid weekly, that's $74.42 that comes out of your income every week that goes back. Now, how we commented on the novated lease and it being a voluntary repayment, this is not a voluntary repayment either. So it is going to be calculated as a liability in when I do all your servicing calculators. So how that really impacts people is primarily the higher they go in their income, the more that they are actually, more of a percentage of the income needs to be paid as compulsory repayments. So the second link that I will put into the comments is an actual calculator. So you can see if you're considering going for another job or if someone's offered you a pay rise, how is that going to affect your HECS repayments? So that calculator will actually give you that figure. So it's an annual figure that needs, I need to mention it's an annual figure. So you just divide it by, if you get paid monthly, 12, if you get paid fortnightly, 26, or if you get paid weekly, divide it by 52. And that's how much you will need to, you will have taken out of your income and how much will be calculated by a mortgage broker.
I see, I see. That's actually very good advice there. Any other tips that you can share with us today about like securing a mortgage? Because I think a lot of us that especially I see a lot of the ladies that who are coming out from like a marriage, they're looking to buy something for themselves. And I find that a lot of people think that it's impossible. So I want to hear from your point of view, how do we make it more possible or achievable?
Okie dokie. So the federal government have got some grants available at the moment. So you've got the first home guarantee, which is for people who've never owned a home before. So it's a 5% deposit. And what that does is there are certain lenders who are in an agreement with the federal government to have you come in with a 5% deposit instead of the full 20%. So it's a low deposit scheme that is aimed at, I'm going to say medium income earners. So there are income thresholds. It's $125,000 for singles. I will get back to you on figures because they are updating these regularly. And there are home value restrictions, and they are dependent on which state you're actually in, whether you are in a capital city or whether you live regionally. So I will actually put a link in for the first home, the first home guarantee. So they've got that one, and this is all being provided by Housing Australia. So that will be the overarching website that I will put up. Another grant is the family home guarantee. So this one is specifically targeted at single parents. One of the caveats of this is you can't just be separated. You actually have to be divorced or single without a de facto to be eligible for this. This grant is a 2.5% deposit, so half a deposit of what you would need for your first home guarantee. So I'll just do a quick bit of maths here. So the average home here in Western Australia is, we're looking at 650,000. So a 2.5% deposit on a $650,000 house is 16,250. So it sounds like a lot of money, but when you compare it to, say, the minimum 20% deposit that some lenders would really ideally like you to have, that's $130,000. So 16,000 compared to 130 is a big difference. Now, that deposit doesn't have to be genuine savings. There are some lenders who will take into consideration a gift from a family member. It has to be a non-refundable gift, so it's not a loan. It is a true, honest gift. We can also take into consideration rental ledgers. So we know that rents are really, really high. A portion of that deposit can be made up of your rental ledger. So if you have actually been paying, let's say, $600 a week in rent, they will actually take some of that into consideration as part of your deposit. It doesn't have to be genuine savings. It is lender specific. So before moving forward, I would have to know that that is going to be part of your deposit.
That is a big help, like that 5%, that is a huge difference.
It is a massive difference. So what is also really good about these grants is, I don't know if people are familiar with lender's mortgage insurance, or LMI. So that is an insurance that is paid by you, the consumer, to protect the bank or the lender if you don't, or if you are unable to make your repayments. And so if you've got a 20% deposit, you actually don't have to pay any lender's mortgage insurance. With the Housing Australia grants, the federal government is actually covering that difference. So if you've got a 2.5% deposit, the federal government is covering 17.5% of your deposit, so you are not having to pay lender's mortgage insurance. So that can actually save potentially tens of thousands of dollars on your mortgage.
Mm.
So
That is a big difference.
absolutely. So if people wanted some more information on what lender's mortgage insurance is and then how we can avoid it, I'm absolutely happy to talk about that as well.
Definitely. I have put it onto the comment for everyone if you need, because like an interview is only 20 minutes. We can only give you so much information. Best thing is that Mandi is willing to offer you an extra 30 minutes if you mention the code YTG40 to let people know that there is a possibility, because I have seen a lot of ladies that got out of their marriage, they're trying to restart again and they just don't know how. And it looks like that owning our home, it seems so impossible. And hearing from you about all those grant and the 2.5% deposit, 5% deposit compared to 20% deposit, that's a huge game changer for a lot of us ladies here.
It is. There's also special considerations as well. So if you are actually separating from a partner and you're having to not go and buy another house again, but you want to refinance the property that you're in, if it's court ordered that you are going to be purchasing and buying out that partner so you can take them off the mortgage, I can certainly help with that as well. And there are special considerations in regards to stamp duty as well. So some stamp duty exemptions. Again, it'll be a case-by-case situation. But if you are paying out someone and removing them off a mortgage and it is court ordered, yeah, I can work with your lawyer to be able to facilitate that, the looking at your finances and being able to essentially refinance the mortgage so that you can get that complete separation.
That is amazing to know. Just to let everyone know, Mandi is our strategic partner in our group here. I completely trust her on her advice. So everyone, if you need help in this area, feel free to reach out. If you are in the real estate, if you're in the lending business, if you're a financial advisor, feel free to connect with Mandi as well, because I do believe having that contact sphere to be able to support each other so we can help more women to become self-sufficient. That is our big goal of our community here.
Absolutely. As a mortgage broker and personal finance broker, I legally cannot give advice on superannuation or retirement or strategies for wealth creation that involve shares. But financial planners and financial advisors can. So if you are a financial advisor or a financial planner, please feel free to reach out, because I would love to be able to have a network of women that I can refer clients to, because women trust women. And when you've been in a narcissistic or domestic violence, or just in a situation where you feel like you are made to feel inadequate or stupid, I'd love to be able to refer a woman to a woman just to have that empathetic approach.
Definitely, that is why that our community has been so successful. Is because that we are holding on to that goal of making sure that women do support women. Thank you so much, Mandi, for being with us today and sharing all your expertise. I look forward to your 5-day presentation as well. So everyone, Mandi do have an expert hour presentation on every Friday that where she will talk about a particular topic. So do check out her presentation. It will be pinned on the feature post, so it makes it easier for you to find. And later on, if you wanted to get her replay, make sure that you go on to our membership portal. It is still free this year on Yeah the Girl 40 Plus. So thank you once again, Mandi, for joining us today. We had learned so much from you, and I'm sure that our ladies here will feel that there is a way for us to find a home again.
Thank you very much, Martha. And I am very humbled to be here and helping where I can.
Wonderful. Thank you for our audience and listener for joining us today on Business Monday. We look forward to seeing you next week. Have a wonderful week ahead.